Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. It's good to be back after a break and looking at the movements. It seems like market is like a child with ADHD. It always seems to shift its focus quickly from changing narratives from the war to the inflation to the yields and whatnot. More recently, renowned hedge fund manager Bill Ackman publicly announced that he covered his short bond trade and yields have tumbled down since. Good morning, JK. Uh, Question for you: is it a top for the yields, or do you think it's just settling into a newer, higher range?
Good morning, Swaraj. See, sometimes markets listen to big investors rather than authorities, and that was certainly the case this week when market started cutting their short position on the bonds, and in fact buying the bonds afresh also. But if I had to say whether the yields are topped out, there is really not a definite answer, because we still have US economy outperforming others, as yesterday's PMI showed very clearly. Then we will have the GDP number tomorrow, which is expected to be in the region of 4.3%, and can surprise to the upside as per many analysts. And this will ensure that Fed will keep higher for longer theory. In fact, the question now on minds of some people is how higher for how longer? That's the question people like to. So I'm not on the camp that the US have topped out, US yields have topped out. But the important point in the Ackman statement is that there is too much risk in the world to bet against the bonds. So that is something that we need to see, whether we are going to see a different picture on the US economy in the coming months, and whether it's going to see a sharp slowdown. There are reasons to believe that it can slow down, so though it has not yet been reflected in the data so far. So that it's still a wait and watch as far as the bond yields are concerned. Yes, after falling 20 basis points, both on 30 and the 10-year, we are seeing some consolidation and waiting for next clues on the bond yields. On the other side, we did have, the Japanese bond yields also hitting a new high, and then the Bank of Japan promptly came in and announced a new bond buying operation and started to, rein in the bonds. There was also a dovish statement from PM of Japan, who said that the BOJ will continue to see that, Japan gets out of the deflation completely, and this is also again dovish statements. All in all, there is a bit of support to the bond prices as of now. And now, when the bond yields are also coming down, we are definitely not sure whether it is due to slowing economy or it is a safe haven, because the war side is actually now into a relative calmer situation. We did have the conversation between President Biden and the Saudi prince for de-escalation. The premier of Qatar also called for peace on both sides. So there are efforts to de-escalate, and this can actually support the yields because the safe haven element will be gone. But then it's the value buying bonds as well as possible slowdown in the economy. So that's about the bonds. As far as other news, importantly, we had mixed news from China. Chinese central government will issue an additional 1 trillion yuan of new government bonds. This is actually adding to their fiscal spending, and that was something that supported the risk sentiment. Although Chinese market did not react much, we had other markets somewhat supported because of that. On the negative side, we have seen capital outflows from China rising to 75 billion in September alone, and this is the highest outflow that we have seen since 2016. On the data side, yes, as I already said, Eurozone business activity was a negative surprise, and the feeling is that Germany data has actually confirmed that they are continuing to be in a slowdown situation, and at best Eurozone can be a flat growth this quarter and the next quarter. That is the expectation as far as Eurozone is concerned. Just compare it with the 4.3 GDP that is likely to come out from the US side. UK data was also quite weak on both sides. Employment showed that the number of people employed came down although the unemployment rate was at 4.2%, which was better, but the unemployment number of people unemployed was also higher. The PMI data from UK was once again on the lower side. The composite index was at 48.6 versus 48.7. It's not about whether it is 48.6 or 48.7. It is continuously staying below the 50 level, which is the dividing line between expansion and contraction. Now, stocks did get some push from China news and yields correcting, and more importantly, the corporate earnings have been supporting. Some big companies like Meta, Google are likely to announce the results, and people are expecting better numbers from these companies. So, all in all, the 2 days of trading on Monday and Tuesday actually erased the losses that we saw on last Friday. Something that needs to mention is the big rise in cryptocurrencies, and which has risen in fact, which has Bitcoin rising to 18-month high, and yesterday alone it was 7% up, and this is alone also being seen as some sort of a safe haven buying. Then gold also got supported at 1850 levels, and started to resume its uptrend, although the momentum is quite low. And on a relief for many of the economies, oil prices have fallen. Brent has fallen 2.08% and WTI 2.13%, thus losing all of its Middle East war premium. Intensified de-escalation efforts and weaker growth picture from Eurozone and UK actually helped the prices to come down. Although the uncertainties in Middle East will keep the prices supported, we will keep an eye on the economic prospects of major economies to determine the demand situation. On the dollar front, obviously the outperforming data from US helped the dollar recover all of its losses that it suffered on Monday. But the dollar's fall was also due to the overbought condition that we had seen in the short term. Now, as we head into the big four rate decisions, that ECB tomorrow, then Fed, BOJ, and BOE next week, I think markets are going to be, little bit skeptical about any big moves. And of course, GDP can be somewhat of a, market mover. PCE core inflation on Friday expected to be slightly lower. May not see dollar sell off that much because overall situation in the US is quite strong. And on the dollar, we feel it will be range bound. If anything, euro will be more vulnerable than other currencies, because ECB definitely is now going to take note of the recent data, and not only pause, but will also be a bit dovish in the statements. As far as the rupee is concerned, we have seen about a strength in the rupee in the last few days, particularly in the offshore hours. And so there could be some flows in the pipeline. But it's really onshore has always seen some good buying in the market, which is eventually supplied by the central bank. So I don't see easy break of 83.30 range, but in any case 82.90 remains a very strong support. Thank you.
Thank you, JK. And yields coming down was the highlight, and I really liked what you said. Markets are listening to big investors more than possibly even central bankers. So that was an interesting point. And we saw Japanese yield hitting a new high post, which the central bank started buying bonds to taper the yields. When it comes to China, Chinese central government is issuing 1 trillion yuan worth of bonds. But capital outflows from China is rising, which rose to $75 billion in September, which is the highest since 2016. So that's more on a worrying front. When it comes to data, on a relative basis, it seems US economy is still better, because in the Eurozone economy, we are seeing the growth seems bleak, especially with the German economy acting like an anchor. And the recent data when it comes to US PMI numbers staying above 50 is a somewhat of a positive sentiment for the economy. For rupee, there was some relief as we are seeing oil prices falling. At the same time, a little bit of strength, especially in the offshore markets, was seen, possibly due to some flows. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.